right, everybody, welcome back to another video here on Financial Friends. Today, we're going to be talking about reinvesting your dividends and obviously the dividend journey. So if you are new here or whether you are a returner, I hope that you can gain something from this video. I think that everybody will be able to get something from this. And without further ado, let's just go ahead and dive right into it. So first things first, the portfolio, the dividend journey portfolio. I went ahead and added $5 of Apple to it and $10 of SCHD. Now, if you're new here and you have no clue what's going on, this is a portfolio that I have built week by week by week, $5, $10, $15, $20 at a time, dating back to, I think, October or so. So you can go ahead and check the rest of the dividend journey playlist out if you are interested in seeing how this portfolio has grown. But for everyone who is a returner, and now for you newcomers as well, here's what the portfolio looks like. Again, we added $5 of Apple, mostly as an homage, you'll see a little bit later, and $10 of SCHD, just continuing to build it through and through. Now, I'm very excited for things to kind of start to kick off, get over the 500 mark, get to hopefully the 1,000 mark. And the reason for that is because our dividend positions are going to get larger and our dividend payouts are going to get bigger and our reinvestments are, of course, going to get larger. So this 5 cents, this 19 cents, this 35 cents, this $1.28, it's going to get larger and larger and larger, because we are always going to have our dividends be reinvested and they are never going to be paid out to us. Now, way down the line, of course, yes, I'm going to have these dividends being paid to me. Maybe they're going to cover expenses or something of those sorts. But for the time being and for the foreseeable future, they will be reinvested. Now, this is why they'll be reinvested. So obviously you could see Mr. Buffett there, but there are three main ways to grow your portfolio. You can buy more stocks. So you can have 1 share, buy 2 shares, buy 3 shares, buy 4 shares, and just build up your position over time. You can wait for price appreciation. So you can own 1 share and you can say, that's it. I'm going to buy and hold. I'm going to wait for it to go from $100 to $200 to hopefully $300, et cetera, which would be insane, by the way. Or you can, and I'm hiding it a little bit here, you can reinvest your dividends. So if your stock pays a dividend, you can go ahead, have that dividend, when it is paid out, be automatically reinvested, and you will be buying more stock, and you'll be accumulating a larger position in anticipation of price appreciation. So obviously a lot of these dividend growth stocks or dividend growth ETFs, companies that do pay dividends, but they're still continuing to grow as a company, companies like Apple and Visa, and there's a myriad of other ones as well. These are going to be key positions where building up, allowing dividends to be reinvested is going to literally pay dividends into the future. So let's go ahead and talk about compound interest, because in complete and honest, that's what reinvesting dividends is all about. It's all about feeding in to the loop of compound interest, feeding into the fact that over time, as you grow a larger position, you get paid more, which means you grow a larger position, which means the next time you get paid even more. And it's just this vicious, positive cycle that you want to have happen in your portfolio, but it takes a very long time. So here you can see that $50 turns into, or $1,000, let's say, yields 50. If that 50 is reinvested, that 1,050 will now yield 52.5. And then that 52.5 is reinvested, which will yield 55.13. And it will just continue to grow larger and larger and larger over time, which is exactly what we want to happen. And we will start to see something like this massive separation in these two charts. One obviously with dividends and one without. And that is an absolute key component of all of this. This gap, this separation becomes larger. And the reason it becomes larger is we have our dividends reinvested. And in periods of dips or little drops in the market, whatever it might be, we're accumulating shares at a discounted rate or at a cheaper price than we had them before. And it's allowing for massive, massive upside. As you can see here, the separation is huge. And then we see another dip, an extended period of a dip here, and a massive run up. And that is because, again, we've accumulated additional shares via our dividends and not just held one position over time and just let it ride. So obviously this separation gets larger, which gets larger and larger. And you could see here within this dip, a massive run up compared to this small little dip that we had here because our position was relatively small and barely even breaking even versus an absolute massive run up and very clearly not breaking even. So this is kind of how Warren Buffett has done things, and it's not necessarily through dividends that he's built these massive net worth that he has, but instead it's through compounding. It's the same concept, just without dividends. So let's say he earns a 10% gain on a company. Let's say $100 for easy math. He now has $110. Well, if he puts $110 into a new position and he gets 10%, he's going to have $11, which he can then make a position of $121 in his next company, and so on and so forth. And that's why his patience, his smart investing, and some dividends as well, has allowed his net worth to skyrocket in his later years. And that's really what we're looking to do with our dividends. We're looking to build positions over time that are going to compound and grow. And so when we do get into our 40s, our 50s, our 60s, we're able to build these positions up to where now we're reinvesting $500, $600 every time we get paid, which is basically the size of my portfolio right now. So that's what we're looking to do into the future. And I think this comparison here is a bit more realistic. So here we have Investor 1 and Investor 2. Investor 1 starts at age 25 and Investor 2 starts at 35. And there's that 10-year gap. This is shown right here. Okay. Investor 1 invests $5,000 for 10 years in a row, total of $50,000, and makes no more investments for the remainder of their life. However, Investor 2 invests $5,000 for 30 years in a row until reaching 65, which will come out to about $150,000, and they do not see the same price appreciation as Investor 1. And the reason being is compound interest. There was more time between the growth that Investor 1 had. She had a runway of about 45 years versus a runway of only 35 years, or 30 years rather, with Investor 2. So it comes down to 10 years. Just 10 years can play a massive role. So we want to get our dividends being reinvested over time so that we can see this price appreciation, and we want that to happen as early as possible. So if you did enjoy this video, if you were able to get something out of it, do go ahead and leave a like down below. That would be greatly appreciated. And comment down below. If you didn't see this already, well, now you do. What is your favorite stock? I'd be very curious to know. I will see you all in the next video. I hope that you enjoyed. Hope that you learned something. And take care.